If you've bought, sold, or even swapped a single Satoshi in Australia this year, the ATO is watching, but don't panic. For the 2026 tax season, the rules have changed and the enforcement is stricter than ever. Welcome to your complete guide. Today, we're breaking down everything from basic CGT to complex DeFi rewards, specifically for the Australian market. First things first, the ATO doesn't view crypto as money. To them, it's property, a capital asset like shares or land. This means almost every move you make triggers a taxable event. Let's look at the big four disposals. The most common is selling your crypto for Australian dollars. You calculate the gain or loss based on the AUD value. Second, swapping. Trading Bitcoin for Ethereum is treated as selling Bitcoin for AUD and immediately buying ETH. Third, spending. Using crypto to buy a coffee or a laptop is a disposal. The value is locked in at the time of purchase. And fourth, gifting. Giving crypto to a friend isn't free for tax. It's treated as selling it at its current market value. To calculate your gain, subtract your cost base, what you paid plus fees, from your sale proceeds. Don't forget to include gas fees and exchange commissions. These reduce your gain and your tax bill. Now for some good news, if you hold your crypto for more than 12 months, you get a massive 50% discount on that gain. If you made a $10,000 profit on Bitcoin held for over a year, you only pay tax on $5,000 of it. But not everything is CGT. Some crypto is treated like a salary, or ordinary income. This is where staking comes in. When you receive staking rewards, they are taxed as income at their market value the moment they hit your wallet. The same goes for airdrops and mining rewards. These must be declared as other income on your tax return. DeFi interest and yield from liquidity pools are also generally taxed as income. It's complex, so keep precise records. A 2026 warning: wrapping your tokens, like turning Bitcoin into wrapped Bitcoin, is a taxable event. It's not just a transfer. For those with a self-managed super fund, 2026 brings an extra 15% tax if your total balance exceeds $3 million. High net worth individuals may also face a landmark 15% tax on unrealized gains, meaning tax on paper profits you haven't sold yet. Think you can fly under the radar? Think again. The ATO's data matching program tracks up to 1.2 million Aussies every year. They get data directly from exchanges, both here and internationally. They see your name, ABN, and every transaction timestamp. The ATO now keeps this data for 7 years. An error you make today could lead to an audit 5 years down the line. Austrac has also clamped down on crypto ATMs with a $5,000 limit to prevent scams and money laundering. What about exemptions? The personal use rule exists, but it's very narrow, only for small, immediate purchases. If you hold crypto as an investment, you can't claim it's for personal use. The ATO is very strict on this distinction. Remember the tax-free threshold. If your total income is under $18,200, you might not pay tax, but you must still report. Good news, moving crypto between your own wallets, like from Binance to a ledger, is not a taxable event. Now let's talk about NFTs. Whether it's digital art or a gaming asset, the ATO generally treats NFTs the same as other crypto assets. Selling an NFT for Ethereum, or even swapping one NFT for another, triggers a capital gain or loss that must be reported. If you're playing games and earning tokens, those rewards are likely taxed as ordinary income at their market value. What if you lose your keys or your crypto is stolen? You can claim a capital loss, but you need substantial evidence for the ATO. You'll need the wallet address, the date it was lost, and in cases of theft, a police report or evidence of a scam. Be careful with wash sales. Selling at a loss just to rebuy minutes later to offset gains is considered tax avoidance by the ATO. However, genuine tax loss harvesting, selling underperforming assets to offset gains, is a perfectly legal and smart strategy. Entering a liquidity pool is complex. Receiving LP tokens in exchange for your crypto is often seen as a taxable swap. Impermanent loss only becomes a realized loss for tax purposes when you actually exit the pool. Timing is everything. For SMSFs, your crypto must be valued at fair market value every year on June 30th for your auditor, no exceptions. Crucially, your SMSF crypto must be in a separate wallet from your personal assets. Mixing them is a major compliance breach. If you're trading with high frequency and a business plan, you may be a trader rather than an investor. This changes everything. Traders can deduct expenses but lose the 50% CGT discount. Most beginners will always be classified as investors. Don't forget stablecoins. Even though they target a dollar value, swaps from USDC to USDT are still reportable disposals. Unlike the US dollar, crypto is not a foreign currency for tax purposes in Australia. Standard CGT rules always apply. Remember that gas fees on Ethereum or Solana can be added to your cost base. High fees can actually save you money on tax. The easiest way to track this is through software. Connect your API keys or upload CSVs from your exchanges. But software isn't perfect. Always verify that your transfers between wallets aren't being miscounted as sales. A common mistake is double counting. Ensure your software knows that a transfer from exchange A to wallet B is the same asset. For obscure tokens, software might miss the price. You'll need to manually find the AUD value at the time of the trade. What triggers an audit? Large, unexplained wealth increases or inconsistencies with your bank account data are major red flags. The ATO sees your bank deposits. If you withdraw $50,000 from an exchange, they'll be looking for a matching CGT report. If you realize you made a mistake in previous years, it's better to tell the ATO first. Voluntary disclosure can reduce penalties. A crypto-savvy tax agent is worth their weight in gold. They can handle complex DeFi and provide audit protection. Inheriting crypto? Generally, you only pay tax when you sell it, but the cost base might be what the original owner paid. Check the records. Donating crypto to a registered charity can be a tax-deductible gift, but it still counts as a disposal for CGT purposes. Getting paid in Bitcoin, the AUD value at receipt is taxed as salary. If you hold it, any growth is later taxed as CGT. It's a double-layered tax. If your DeFi loan is liquidated, that's a forced sale. You still owe CGT on the difference between your cost base and the liquidation value. Rewards from DAO participation are generally ordinary income. Even if it's just a few tokens for voting, they must be declared. Hiding crypto on offshore exchanges, Australia's new global reporting standards mean foreign exchanges now share data with the ATO. Avoid the tax loss headache of lost keys by using secure backups. A lost wallet is a lost investment and a tax reporting nightmare. Be strategic. Carry your losses forward to years where you have high gains. This is key to long-term portfolio growth. Before we wrap, did you check for the 12-month discount? Did you declare all staking? Are your records ready? I've put links to the official ATO guidelines and my recommended tax software in the description below. Crypto tax doesn't have to be scary if you're prepared. Stay compliant, keep good records, and I'll see you in the next guide. Stay informed as the landscape continues to evolve through 2026. This masterclass was designed to help you navigate the complex world of Australian digital asset taxation.